Well, hello and welcome to Bloomberg Quint. That day is finally here. The Nifty has finally hit a new lifetime high, well above the mark of 9122.75 in a round. But the question is, does the Nifty move up further from here? Can we expect some amount of consolidation, or for that matter, can we actually expect some amount of correction? For that, well, we are once again in conversation with Mr. Ajay Bagga. He's a market expert here. Ajay, thank you for joining us.
Thank you. My pleasure.
And so, well, that is going to be my first question. Where are the markets headed, specifically the benchmark indices from here on?
So it's taken us 2 years to come back to the previous lifetime high. So right now we would like to celebrate. It's a good move. I think the market had not anticipated such a strong mandate for the ruling party. And that brings a lot of continuity, a lot of stability, a lot of policy making continuity as far as the market is concerned. And normally that is positive to attract investors into the markets. What I'm afraid of is the market has moved up fast and furious. Right. So this year, YTD, beginning of the day, we were 9% up. Probably with this move, we are 10.5%, 11% up
right.
YTD. We have outperformed emerging markets. So we are an outperforming market. We are overbought and we are overvalued. So the three O's really are a dangerous combination.
Right.
We saw that in September 2013 to about March 2015. There was this kind of a run-up in the markets. And then we saw a digestion. So May 2014, by the time government took over, most of the run-up had happened. Right. Then it was a sideways market, reacted to the Chinese correction, and then went down.
Right.
And then we saw it making a lifetime high. And since then, it's taken us 2 years to come back. So time-wise, we've had a lot of time. Indian macro has recovered. We are in a better shape than we were 2 years back. But price-wise, the valuation, people are saying the price-earning multiples will expand further. These are expanded multiples. You look at 1 year trailing or 1 year forward, we are roughly about 15% to 20% overvalued from historical averages. Now, markets are sentimental, they will overshoot. Right. So from here also, they'll probably go another 10-15% more on the valuation front before it becomes obese and it just comes clanging down. So I would be worried. I'm happy I didn't have any shorts. I'm a net long player in the market, very bullish on India. But just on this event to play so much in the market, I think we are overdoing it. So overbought, outperforming, and overvalued.
Right.
Okay, so there is a clear cautious undertone to Ajay's words. But Ajay, how much importance do you think the markets are likely to attribute to the FOMC meeting on Wednesday? Do you think that a Fed rate hike is already priced in now? It's almost a given. Do you think that could really dent the momentum, at least in the near term?
I think it's factored in. And markets are a bit complacent. The interest rate futures are showing nearly a 90% kind of probability. Okay. Once it crosses 70%, it's on. So I think the bigger issue will be how many hikes from now. So the dot charts will be critical. The commentary will be critical. Is it 3 hikes for the year or 4? And I think Janet Yellen will reserve her mandate, because even yesterday I was watching Bloomberg, and the Senate majority leader was saying that by August, September, we should have our tax reform in place as well. So first is Obamacare, then they get into regulation being loosened up, infrastructure spending, and then fourth will come as tax reform. So the US budget this week will have a big deficit, enhanced defense spending. I think that could spook the Fed somewhat, because they were watching they thought there's rhetoric and there's actual policy action. It seems that it's very convergent in the case of Trump. He's actually taking those actions, what seemed like rhetoric or extreme right kind of positions, like travel bans and stuff like that. So if that translates even into the economy, I think he's saying he will find $1 trillion more by cuts into a lot of services apart from the basic services, and that he will use for his infrastructure spending. that remains to be seen. So I think Janet Yellen will stay on the fence as far as the commentary goes. She'll say we'll be data driven, but we are looking at a neutral stance rather than accommodative. I think those are the two things we'll watch out. But markets are more complacent, especially emerging markets. We should have seen a sell-off based on a Fed hike coming in, because traditionally money moves out. So the big foreign investors move out, currencies go down, dollar strengthens. We have not seen any of those plays because there's a lot of other plays that are happening. So MSCI Emerging Market Index is up about 8% YTD. We are up nearly 11%. It does not normally happen in the beginning of the rate cycle, because again markets get very fearful at that time, and they bake in a lot of the fear. Rather, on a 15-18% per year market, we are baked in 11% already. So I would be a bit cautious. Markets are complacent.
Okay, so you said that traditionally money moves out, but considering this victory that the governments had in the state elections, what do you think the FIIs are thinking right now?
FIIs have welcomed it. See, what it gives you is about 7 years of outlook, that probably the same man will be at the helm for the next 7 years. 2019 looks more or less a done thing if these trends persist, because 2 elections out of 2 in UP, you've got such a huge mandate, 40% plus vote share. I think it's theirs to lose now, 2019. So FIs are watching it very positively. Over the weekend, all the calls that we were on, people really welcomed this mandate as a continuity and stability mandate. What I think the market is missing is that the winnability quotient is really coming from populism, is coming from targeted subsidies, there is a clean administration which is very good, but ease of business has really not moved ahead. Job creation has really not moved ahead. So it's still a lot of a hope rally. Plus on the ground there has been a lot of good work. 2 crores gas connections being given, 50 lakhs in UP itself. That has probably made a big difference in the vote count. I think there will be a lot more focus on that. So when we are investing in these markets, don't invest as Modi as a bold reformer. Invest in Modi as a populist, soft left of center, instead of a rightist BJP traditional prime minister. Is going to be a soft left of center, more populist, more appealing to the voter segments rather than to the investor segments. So the 2009 onwards capex degrowth that we have seen, we don't see that returning very fast, which is a difference from the 98 to 2003 cycle, where we had seen a similar thing, and towards the end of Vajpayee's term, the capex cycle had revived. And Manmohan Singh was the biggest beneficiary. He got a 10-year mandate based on the hard work of Vajpayee. This 2009's onward slowdown has really not turned around yet in the private sector. Be it bank NPS, be it very highly leveraged bank corporate balance sheets. The overall free cash flow has improved, yes, that is coming through. The exports are better, Baltic Freight Index is better. So there is a lot of global macro which is positive for us. But all I am cautioning is a lot of that is baked in. So markets have run up ahead of themselves. Might be a good time to digest. I'll be probably totally wrong as far as this goes, because markets are manic depressives. They will just keep running. They'll probably go 9,300, 400, and then it'll become a very overweight market, and all of a sudden you'll see some amount of correction. Or it could be 8,800 lower bound has gone to 9,000 now. So again it consolidates. And that would be better if it digests this, takes it slowly, and then follows some fundamentals. But markets never do that. We keep commentating and wishing.
Ajay, you're talking about the global economy, so I just wanted to understand commodities. So I'm talking about energy as well as the base metals. They had seen a fantastic run-up or rally last year. Now, given the fact that some of the economic indicators seem positive, but somehow you've started seeing some sort of a profit booking or reversal in the trend as far as commodity stocks are concerned. Any thoughts on that?
Yeah. See, oil has been, it has really killed a lot of hedge fund longs this time because Russia didn't play ball. And in fact, I remember in one of your programs we were talking, and I was quite confident that the OPEC agreement won't come through, and it did. Yeah. And I think the Saudis played ball because they were up to the neck in trouble, and they wanted the rate hike. Second, as the US shale recovery. See, oil, you need multi-year investments before oil wells start producing. So. But what we didn't figure out was that there were a lot of explored wells which were just put idle and at $30. At $50, those became viable, at least on a marginal cost basis. So the rig count went up, huge inventories came in. So oil is different. Oil is very positive for India. It's a good move, and it will show in the government, remember, in the budget has taken about $58 oil. So you get a $6-7 oil boost. And if this stays at $50 Brent, it's a huge positive. And apart from that, if the rupee stays strong, that's another kicker. Other materials will largely depend on China and the US. So the Trump infrastructure play and China continuing to spend. The other issue is China cutting capacity. So aluminium, iron ore, steel, we have seen that impact coming through. Because of capacity cuts and then strikes in other areas. We saw copper getting impacted by a Chilean strike. So overall demand supply is not as bad as 3 years back when the material down cycle had started. It corrected and it outperformed because again markets had gone too bad, too low, and a lot of capacity was mothballed. I think there I am more positive for another positive year for materials this year. So I don't see the steel, copper, aluminium majors really correcting. Okay. And there will be a lot of consolidation. So the smaller non-performing loan hit kind of players will get taken over either by sale, the government behemoth, or they will ask private players to step in. The banks will ask them. I think some you will see some consolidation of capacities there. No new capacity really coming in for quite some time. Globally, there is very little spending on new capacity. So materials looking okay, oil not looking too good. Russians, I don't think they played ball, and very difficult to foresee them coming through. And then with Trump as a president today, he's going to give more subsidies to domestic production. Overall. The shale producers will see if there is a tax cut, if there is, Make in America is his big theme. So if you can make all your oil and gas in America, he will give a big subsidy for that.
Right. Okay, so assuming that the Nifty is at around 9,000, it remains around 9,000 for some time. That means that we're still counting on price to earnings ratios of around 20-21 times. When do we see earnings catch up to these valuations?
Yeah, a very good point. And from where? One is when and which sectors would really see. IT, pharma are largely linked to the global play, and they will move in line with the global play. So unless America grows at 3%, IT is difficult to break out of the 8% dollar number.
Right.
Sectors that will do well, I think. Again, go back and think, what will this government do? A lot of rural focus will come in. Day before he spoke about, day before he spoke about the middle classes again. So some kind of a tax cut coming. That will have a direct bearing on consumption. So all the consumption themes, the domestic consumption themes, you can look at FMCG, durables. It looks like a very hot summer coming up. Durables should do well. Two-wheelers, they've had really bad 3 months. I think that will turn back again as the more money comes in, the harvest comes in by March, April. And you'll see two-wheelers starting to turn. So two-wheelers might not be a bad space with a 1-year horizon. Think of next November, even at flat rates, you would be up 22%. You were minus 22% in November, December. But already that fall is plateauing, and then it will come back again. That consumption stays. And then sectors like housing finance companies, which will fund the affordable housing,
Yes, of
cement,
course, yes.
cable,
Right.
metals, all that go into this construction boom that's coming.
Right.
And it becomes a virtuous circle. So if you employ more people, you're able to do a lot more construction infrastructure, and affordable housing takes off. It becomes a very virtuous circle. You're employing more people, they are spending more, so more houses are in demand, and it starts.
Right.
Good thing is there is no capacity expansion which is there.
Yeah.
So operating leverage will play very strongly. Cement can produce another 10-15% very easily without getting stretched, and then you will see the capex cycle returning.
Right.
So when is about a year. Where is all these sectors? What will be the catalyst is if the government follows through. This government has been very good in following through. Targeted subsidies itself, they are saving about 50,000 crores a year. That has given them fiscal space without really beating the fiscal deficit.
Right.
Yes, there's so much which is needed, be it health, be it education. There's no money for that. So don't expect very big outlays for that. If we can just build the infrastructure and increase the ease of doing business and skill India, there is enough focus on. I think those 3-4 big things they will look at. 2 years is not a big time now left for them. I think the focus will go radically into how do we do more of these things which have won us UP, rather than doing what is good for industry and how do we take India to 10%. I think that will not be, that's now a 2019 June kind of a outlook.
So Ajay, you're saying that the interest of or the revival in the consumption-linked sectors is going to come back because these were the stocks that investors had actually shunned after November.
Yes.
So you see,
and they were totally wrong. If you see, at least the GDP numbers are showing private consumption went up 20% plus. So whatever be the reasons. So we are a very developed economy in the way of, we are Japanese and American in that sense of 60-70% of GDP coming from private consumption. So government has never been that huge. Private investments have never been that huge in this country. We had a brief period in last 2 years of Vajpayee and first 2-3 years of Manmohan Singh, which was a global liquidity based infusion, and private capacity went up. And we are still trying to address that, both in NPS and idle capacity. So I don't see that coming back that fast. But the big thing that will be is if you can align the portfolios, there is enough growth and stocks will return very good returns in India. Will they return 30-40%? I don't foresee right now. But yes, particular stocks definitely.
Right.
So if you can get into the rural themes, the tractor makers, the rural suppliers, the infrastructure suppliers, again there I'm not for the highly leveraged companies or companies with 4% operating margin, 6% operating margins. There you're better off buying IT with all its trouble. At least it's giving you growth plus a 26% operating margin. And with very well run companies, no debt on the books. In fact, cash hoards sitting on the books. So I would say get into suppliers like power, for example. Now this Uday bonds, UP had not participated. They will go in and participate. So the public sector finance companies' balance sheets will go down, bonds will get issued. But the big thing will be new capacity, new transmission. People will get 24-hour power. I think they are going to come in and focus on that and be able to deliver on that. I think a lot of those things. So fortune at the bottom of pyramid is what you have to see. So I would say microfinance companies, yes, but after 2 months, because farm loan waiver comes in, farmers will stop paying all loans. They will just not pay the state loan. They will stop paying the microfinance company. They'll stop paying the housing finance. So I'm saying wait for 2 months. Let it all settle down. You can look at microfinance companies. You can look at private sector banks. All will come and deliver. So there is enough growth, but all I'm saying is broad macro market making money more difficult.
All right.
Ajay, private banks definitely seem very pricey in terms of valuations right now. So just two questions that are weaving into one. Your preference when it comes to choosing between private banks and government-owned banks. And second, on the back of the recent consolidation buzz in the sector, are there any specific banks that you really like or you think could be good tactical plays?
Yeah, I can't give particular names because of compliance reasons, but how I would say private sector more than public sector.
Okay.
Public sector, if you have to own very small amounts, go and buy the smaller public sector banks. Now again, this is a contrarian thing. Everybody will tell you buy the top 3, top 4. Why the smaller ones? They will get consolidated in. After the SBI and Associates merger, the next move will be to create 4 or 5 big nationalized banks.
Right.
And the smaller ones are not getting the valuation upkicker as the big ones are. So there is value there. It's a high risk strategy. If it doesn't come through, if they decide, okay, next 2 years we won't do it, we don't want to put off the government servants and the public sector employees, we'll not do it in 2019. Then this strategy falls through. So that could be one. But overall private sector banks, within private sector banks, I would say leave aside the top 1 or 2 or 3. Go for the mid-tier private sector banks. There will be targets of mergers. Second, they have much more growth. Then the big ones are good. They'll trundle along and give you good market-beating returns, better than the market. But you might find higher alpha in the mid-tier, the emerging banks, even the newly licensed banks, wherever you can. I think those could be a better bet.
Okay. And just the last question on IPOs. We've had 2 IPOs, the DMart and Music Broadcast Limited. Of course, we've seen stellar subscription, and that also means that most of the investors or applicants are going to be left with no allotment.
Yes.
Would you really go and buy any of these at a premium on the listing day?
And even if it was, what premium would you be willing to pay? So something like a DMart.
See, in India, there's a good thing. There's a grey market which on WhatsApp people keep sending us. So, and they are pretty accurate. Right. In fact, even on the election day, I was getting WhatsApps. So you would have got on what the Gujarat Nifty was looking at, and you know, I didn't know there's a Bhuj Nifty and there's a Kutch Nifty and all. So this is greed. The IPO market is greed, pure greed. People are taking leverage money and for short term and trying to get the bounce up and then get out. So as long term players, you will not get any allocations even if you want to. So should you buy right on the opening? No. Wait for within 2 days. You will see corrections coming in as the leverage players sell out. Right. They have to, because they borrowed money and they came in. Very few will really hold the positions. Okay. And concomitantly, the other players in the sector which got boosted also, there are companies which have gone up 100% without any change in the macro, any change in their operating paradigm. Just because one player has come into the listed space, not even in focus, it's come in the listed space, everybody else gets revalued. That won't work out. So wait, I would say these you have to just wait out now and wait for a reasonable in retail. What do you think? I mean, 40 times PE is what you are looking at as reasonable. So they are looking as FMCG stocks. And I would say look back at the margins. So there are players who are making 7-8%, very good. Amazon makes 3%. Walmart makes 4.5% with all its hard work. And being, I mean, Amazon is the cheapest, you can say. And the targets and all of the world are struggling at 5%. So if there are players who are giving you 7%, well and good. But again, look at concentration. Once you cut down, as I keep saying, in fresh you can't make money. Which is the vegetable, fruits, all that. It's about minus 20% that you make. It is more footfalls that you get along with it, and people buy. It's apparel where you make solid money, and other kind of goods where you make. So look at the concentration. Where is the money coming from in the verticals? That will give you a good idea. So if there is an apparel play, you have margins are good. Those might be better. But you know, this happened in 2007 where retailers were announcing 100 more stores next year and this. I remember only one, my good friend Mr. Noel Tata, he told me I'm not going to expand.
Right.
And he did well. He could see the froth, but all these other players had got overextended. It's taken them a long time to come back. Now they're riding this one mega IPO which is coming. This is pure greed. All the players who are coming in are not retail aficionados who are really loving retail or anything.
Right.
It's more that I'm borrowing money at 10% and I can make 2% flat with a 7-day investment. That's about it. That's why 200,000 crores is coming.
Right. Well, I suppose that's all that we have for Ajay. Thanks. So once again, thank you for joining us. It's been a pleasure speaking with you. As for you guys, well, we'll be keeping track on the markets and whether or not we actually make higher highs, at least in today's year of trade. But that is it for now. And stay tuned to Bloomberg Quint.